Hi and welcome to Swissquote's Daily Market Talk. It's Friday, December 27th. Markets are quiet. Trading volumes are thin, and Santa didn't really show up for the US equity and cryptocurrency investors this year to give a final boost to a stellar year of trading. But the Japanese stocks are quite in a great shape these days on the back of a softening Japanese yen, while the mid and small caps of the US were doing better yesterday. So for all those looking for the Santa rally, the US doesn't really look like the place to be this year because the major US indices weren't in a good shape at yesterday's trading session, and that even after a mixed bag of US jobs data yesterday showed that the continuing jobless claims in the US advanced to the highest levels in more than 3 years, as a sign that it looks like it takes longer for people in the US to find a new job. But alas, the bad news from that data did little to boost the Federal Reserve dose on Thursday and support the equity rally in the US. The US 2-year yield fluctuated between 4.30 and 4.35% range. The S&P 500 was slightly down yesterday. Nasdaq 100 index retreated 0.13%, and even Bitcoin gave back the Christmas Day gains and is settling near the $96,000 level this morning at the time I'm talking here. It's kind of disappointing for the hopes of seeing a final rally for such a stellar year. But the Dow Jones Industrial Index, which has been going against its technology-heavy major peers over the past few weeks, was very slightly up yesterday by 0.07%, and the mid and small caps in the US eked out the best performances as a sign that rotation towards smaller and less technology-heavy pockets of the market that many investors out there are expecting to happen next year could already be unfolding at the end of this one. And not only that, the Chinese equities are also better bid since the Chinese authorities pledged on this Tuesday to sell a record amount of 3 trillion yuan worth of special treasury bonds there next year. So that's worth more than 410 billion US dollars to give support to the sputtering Chinese economy. So the money would be used to boost consumption and investment in China, according to the latest news. So let's see if anyone out there is interested to buy that narrative this time around. Now, the Chinese equities are better bid, as I said before, maybe because there is not much to buy elsewhere. But China's path to recovery will be bumpy, that's for sure. The data released a few hours earlier today show that the industrial profits in China continue to plunge. I mean, they have been almost 5% lower year over year last month, and that the workforce in finance and property markets in China shrank over the past year for the very, very first time. And we are not talking about small numbers here. We are talking about big numbers. The number of people working for developers in China died by 27% since the end of 2023. So good luck to heal that market. Now, one place, however, that's seeing a decent Santa rally this Christmas looks to be Japan, because the Nikkei index there surged past the 40,000 psychological mark today on the back of a weakening Japanese yen, as the Japanese yen bears are out and selling the Japanese yen since the Bank of Japan bypassed a rate hike earlier this month. And more importantly, the officials there said that they're not sure to know what to do until next March or April, because this is basically the time when the Trump policies, his international and tariff policies, will start seeing their impact. So as such, the dollar yen spent this Christmas bumping its head against the 158 offers. Today, though, the Japanese yen looks a bit stronger on the back of a freshly released set of stronger than expected economic data from Japan. that actually show that inflation in Tokyo rose to the 3% mark in December, while retail sales in the country jumped to 2.8% in the month of November, as the contraction in the Japanese industrial production also unexpectedly slowed down during the same month. So if you just look at the economic data in Japan, you could eventually think that the Bank of Japan could and maybe should hike their interest rates again, but they will probably not do it. So, as it has been the case for most of 2024, the only thing that could eventually cool down the Japanese yen's sell-off is that threat from the Japanese officials to intervene directly in the FX markets and buy the Japanese yen, which would then create a sudden reversal of the trend and clear at least a part of the speculative positions against the Japanese yen. It's quite efficient, to be fair, for the short-term traders, but it doesn't really help the Japanese yen gain meat on a sustainable basis. So in plain English, that means that buying the dips in the dollar yen is still an interesting thing to do, and buying the Japanese stocks is still a popular thing to do as well. Elsewhere in the FX, the US dollar index was mostly steady this week, as most traders in major economies were quite busy dining and wining in Christmas parties. But the latter didn't really prevent the euro dollar from gently pushing lower on rising, and to be fair, funded worries that the newly formed French government will obviously face the same exact fate than the previous one. A divided French government that will unlikely approve a reasonable budget proposal from the new government to bring the ballooning French deficit toward the 5% mark. And while the deficits that spiral higher is generally not great news for the euro, as the French-German 10-year yield spread is now preparing to close this year near the 80 basis points level, which is basically the highest level since the European sovereign debt crisis hit a decade ago. Across the channel, hope that 2025 will bring good health to the UK economy, ideal with improved relations with once loved and cherished ones, like the Europeans, persists, but the path remains shaky, mind you. Cable has been testing the 1.25 support to the downside, with, however, a greater chance to break that level to the downside than otherwise. Elsewhere, the Aussie dollar is testing the 62 cents level to the downside, while the USD CAD is trying to find support near the 1.44 level this morning. It looks like Donald Trump's proposal to make Canada the 51st state of the United States didn't improve sentiment there. I'm just kidding, of course. But coming back to the fundamentals in Canada, the rising political risks in the country, and also combined with the unsupportive oil prices of these days, continue to back a further advance in the USD CAD to and above the 1.45 psychological level. And speaking of oil, it's obviously the same old narrative that's going on right now. The barrel makes an attempt above its 50-day moving average, but remains quite topped by offers before reaching the 100-day moving average, which currently stands near the $71.30 per barrel level. So yesterday's API data from the US showed a more than 3 million barrel retreat in US oil inventories last week, but the drawback barely vacuumed the oil bulls in yesterday, and the weekly oil inventory data has little power to reverse the bearish trend that we see in oil prices these days that will stay intact below the $72.85 per barrel level, which is the major 38.2% Fibonacci retracement on the latest sell-off. As such, crude is set to close this year in the bearish consolidation zone, still waiting for China to get better and eventually to narrow the global supply glut that's expected to average near 1 million barrel per day in 2025, according to the IEA. So this is all for this holiday shortened week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them, and don't forget to have a look to our market outlook videos for 2025 on our YouTube channel as well. So I will meet you again next week, and until then, good day trading and have a lovely weekend.